All right, welcome to This Explainer. Today, we're throwing on our financial analyst hats and hunting for some real value in TOMRA's Q2 2026 report. We are looking at a super fascinating clash right now. Absolutely booming global revenues on one side, but rising debt levels on the other. So let's just unpack the whole shebang.
Okay, here's our quick roadmap for today. We'll hit the Q2 financial highlights, check out their debt and asset health, dive into the massive boom in their collection division, look at new value-generating projects, wrap up with recycling and food performance, and then finally peer into the long-term outlook. Section 1, Q2 financial highlights. We're looking at a serious revenue boom versus some shrinking margins. 405 million euros. I mean, that is the sheer scale of TOMRA's revenue this quarter. That is a massive 25% leap from last year. So the top-line momentum, yeah, it's undeniably strong right now.
But, here's the classic yes but scenario. Yes, revenues are way up. Adjusted EBITDA, which of course is a key measure of operating profit, jumped up to 57 million, and cash flow literally more than doubled. But look closely at this. Gross margins actually shrank by 3 percentage points, dropping down to 41.3%. You can really see it mapped out here. Notice the expanding green revenue bars sitting right next to that dipping blue gross margin line. Basically, this is the cost of aggressive growth. All those heavy equipment sales are compressing margins as TOMRA rapidly pushes into brand new markets.
Moving on to Section 2, debt and asset health. How exactly are they funding all this global growth? Well, the answer lies right here in this number, 2.5x. That is TOMRA's net interest-bearing debt to EBITDA ratio. Now, that's a pretty sharp jump from 1.8x just last year. And as analysts, this leverage metric is absolutely crucial. It's a key health check that we monitor very, very closely. So why the rising debt? Well, the crucial point to take away here is that TOMRA isn't just burning cash. They're strategically leveraging debt to acquire assets, like grabbing Clink, and they're consolidating their global position by picking up minority shares in TOMRA Collection Australia. Plus, a slightly lower rolling EBITDA is playing a part too. Okay, Section 3, the collection division boom. This is really the engine of their growth right now. Just look at this contrast. Collection division revenues are up a staggering 45% to 246 million euros, while the recycling division actually dropped by 11%. So it's pretty crystal clear exactly where TOMRA's Q2 momentum is actually coming from. Digging a little deeper into these financials, 69 million euros came entirely from new markets. That's huge. But I should point out, heavy equipment sales for initial setups in places like Poland definitely weighed down those gross margins to 38.6%. So it's your classic trade-off, right? Short-term margin compression in exchange for long-term market share. Let's pivot to Section 4, new value-generating projects. We are talking about a massive regulatory shift here. This brilliantly illustrates what's coming, a relentless, multi-year pipeline of government-mandated deposit return systems, or DRS, that are essentially locking in TOMRA's future cash flows. Poland's transition ends in early 2026, Portugal and Singapore launch in April 2026, and the UK and Wales launch in late 2027. It's like a giant puzzle coming together. And their footprint is expanding literally everywhere. Quebec is upgrading 1,350 machines by 2027. Regulatory triggers have been activated in Greece and Spain. Uruguay is setting up the first mandatory DRS in South America, and Moldova just passed their adoption framework. The runway for generating new value here is just absolutely massive. All right, Section 5, recycling and food performance. Let's see how they're navigating some tricky macro issues. So as we saw, recycling revenues dipped 11%, mostly because of a pretty soft European plastics market. But get this, the gross margin actually improved to 48.9%. This was entirely driven by a much more favorable product mix in their newly launched metals recycling line. And guys, here is the real hidden gem for the recycling division. Order intake surged by 40% to 58 million euros. This is a huge leading indicator. It points to a really strong rebound, driven heavily by momentum in the mining and metal sectors. Seriously, don't sleep on that metric. Meanwhile, the food division saw a pretty modest 5% revenue bump. But we do have a bit of a red flag here. Order intake dropped 22% due to lower conversion for those large packhouse projects. Now, sentiment for the smaller projects is still positive, but it's definitely something to keep a close eye on. Finally, Section 6, the long-term outlook. How are they aligning with these massive global megatrends? Well, management's ambition is crystal clear on this one. They explicitly stated Collection has an ambition of double-digit annual growth over the cycle towards 2030 with a gross margin above 40%. So they fully expect that today's short-term ramp-up costs are going to yield high-margin double-digit growth for years to come.
So that brings us to the ultimate question for us as financial analysts and investors. We're looking at a company strategically taking on debt to capture this massive, undeniable pipeline of government-mandated circular economy projects. When you weigh that short-term leverage against those long-term global megatrends, is TOMRA's strategy a buy? Thank you so much for joining me on this explainer. I'll leave you to ponder that one until next time.